Good morning and welcome to Morning Markets. Today we're going to be focusing on the US economic data and what that may mean for interest rates. In recent weeks, we've been talking about the overall strength of the US economy. Remember, we're coming from a period where the US economy has been exceptionally strong. In recent weeks, however, we have seen economic data soften slightly, whether that come through consumer spending or just general business activity. We start this week by getting more data from the US manufacturing side and the construction side this time. The reading that a lot of economists and investors follow is known as the ISMs, which is a survey of the manufacturing sector and surveys businesses within that sector. The report that was released yesterday showed that we continue to see some softness and cooling in overall economic activity, and especially when we look at manufacturing. If we look at the subcomponents of the manufacturing, when we look at production or employment, we saw some weakness over the month, employment now dropping into contraction territory and production remaining very soft. One positive note would be when we look at new orders. New orders is improved over the month of May, however it still is yet to be in expansion territory. So on the whole, the report was slightly softer, some slight positives coming through the new orders. I suppose the additional positive will be when we look at the prices paid component. So what manufacturers are paying for their goods and resources, what we should see is a further easing in the prices paid. So that will hopefully filter into the inflation data that we'll get in the coming months. In addition to the manufacturing side, we had construction spending. Expectations was for construction spending to grow up 0.2%. Unfortunately, that wasn't the case. It actually declined minus 0.1%. So it wasn't a significant decline, but it was at the margin. I suppose one positive to take would be that the April number was revised higher to 0.3. So I think the data just supports this trend that the economy, US economy, is somewhat slowing but normalizing, I would call it, rather than anything more severe. And remember, we're coming from very elevated levels. So what does this mean for interest rates? Well, if we look at market pricing of interest rates today, the market is expecting about 0.4% of interest rate cuts between now and the end of the year, with the first most likely to come in September. Now, what will really influence this will be the strength of the economy, the strength of inflation, and labour markets. So the economy appears to be cooling, but gradually. We look at inflation report on Friday, it eased from 2.7% year on year to 2.6%. Remember, the Federal Reserve, the US Central Bank, has the target of 2%, so we're gradually getting there. But then the final component will be the employment picture, and we'll get a reading of that on Friday, where unemployment's expected to be at 4% and remain there, which is where the Federal Reserve has it for the end of this year. So if unemployment actually creeps higher than 4%, that may just suggest that interest rate expectations need to be recalibrated, and I would expect interest rate cuts, more interest rate cuts to be priced by the market. That's everything from us today. Thank you for watching, and we'll see you tomorrow.